Let's start out. And actually, I've hoped that Kai would have been here because I actually started out in a little untraditional way by asking, or by putting up a question to Kai saying, why? Why do you put me on in here today? And I know a lot of Twitter people that have been following me on Twitter would say, why are you putting Henrik up? Isn't it like putting a Liverpool fan in the midst of a Manchester United fan zone? Maybe it is. And also from my side, I think it's when I was sitting back home and had to do my presentation, I was also thinking, how can I now come and present this that I want to show you today in a way where I do not get carried out by the end of it and burned at stake, or that you do not want to share a drink with me after the presentation. So I'm going to say first, and lay it out there, I am a major gold buck. I see gold at 36,000 in 10 years' time, but I don't think the path to that level is going to be an easy ride. And this is why I have the gold roller coaster ride in 2025. And I call it the bust and the birth of a multi-year bull market. And let's try to dive into it. I don't want to say too much about myself. Master in economics from the University of Copenhagen, head macroeconomist at Swissblock. And I've developed what is a business cycle model, which is what I see as the backbone of investing. If we do not know where we are in the business cycle, how can we then put our money into the market? Then we're guessing. And also based on that, putting in a multi-market economic market model based on the Elliott Wave's theory. And I live in Copenhagen. This is Swissblock, where I work as a head macroeconomist. Not so much about that, because today we are to talk about gold. And everybody knows gold goes up all the time. Gold is a fantastic investment in the long time frame. And if we look at it, we can just see the compounded annual growth rate for gold. Fantastic. And I see the same. I see gold as the very bedrock of sound financial, monetary policy. We need to have gold at the core. That's why we have central banks having so much gold in their basements. We know that. But as I said, I don't think it's going to be an easy ride for gold from here on. And I want to point to that. And first, I want to go through my hypothesis here really quick. And then I want to tell you why I say that in the midst of the presentation, and then come back to this. So I say we are actually heading towards a recession. I saw Kai have crossed that out in the morning here, and that's a nice, easy thing to do. But I come from the country of Hans Christian Andersen, and like the boy in the Emperor's New Clothes, I like to say, well, why don't we take a look at it? Why is it that everybody talks about a soft landing when we can see that that's really not happening? So I see that we have a deflationary bust coming, which I don't think will be good for gold. I think we'll see gold decline, and quite a lot actually. I think we're going to see the Fed will react, and that reaction, when that comes, will be fantastic for gold. It'll create a whole new environment for gold and for precious metals. And I think gold, as I said then, will embark on the journey up towards much, much higher levels. So this is my kind of way of hoping that somebody will have a drink with me after, saying it may be that we see some volatility ahead, but eventually we will all be right here. As I think we'll all hope that gold goes much higher, and I think also that we're going to see fantastic investments in some of the companies that you represent. First of all, I like also just to point out this is one of my fans, one of the guys that I really think is doing a fantastic job when it comes to investing. And he says gold gets dug out of the ground in Africa or somewhere, someplace, and then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Anyone watching from Mars would be scratching their heads. And somehow he's right. What is it that gold really yields? It is based on that we expect it to move up higher, and if it doesn't, and that is based on that somebody comes and wants to actually pay more for it. It doesn't yield anything on a yearly basis. So gold always goes up. That's what we're told, or at least we know that in a long time frame. Correct. And if you look at the big bull markets, they have been fantastic. If you look at it in the 70s, we saw 18 times up from gold. I think it was from December 1970 up to February 1980. we saw then a 20-year almost bear market where gold came down by 65, 70%. And then we saw another bull market, 7.5 times up into the 2011 top. Then we saw a few years of declines, and then now we have seen a new top again. Everybody seems to believe this is the new bull. Fantastic. I just think gold is disappointing a little bit. Because if you look at when it actually bottomed out, wasn't it 2015? And now we are at 2,700. Compared to the other bull markets we have had, it's actually a bit disappointing. But we know in the long time frame, US deficit and debt will drive the long-term development in gold. And there is plenty of budget deficits. And there is plenty of debt. And that debt will become higher and higher year for year. So I think long time frame, we can just do the math. We can see the correlation between gold price and the debt levels. So why do I expect a roller coaster ride in 2025? Well, let me just get back to this about gold and the price, how it's been developing over the last few years. So since 2011, gold is up by 50%, give or take. But silver, its cousin, is down by 35%. Platinum, its other cousin, is down by 48%. And the gold miners are down by 43%, GDX. That must make our heads scratch. Why is it that gold does so well and everything else around it does not? See, this is where I think maybe gold is not leading. I think gold is bubbling. I think the whole speculation around inflation and debt levels and so on has been leading people into buying gold at a time where it may not be most beneficial. So yeah, prices have gone up. I cannot deny that. But what is really the driver behind it? I need something to, my mouth dries up, so. And if we then look into what I want to get into also, how gold performs during recessions, because people are saying, Henrik, if you're expecting bad times, then why don't you want to buy gold? I mean, everybody knows that's the first thing we get taught after, in school. It's like, buy gold if things are turning bad. That's just not what, we see. Because if you looked in 2007, 2009, we actually saw minus 34% from March to October 2008. That was during what I call the credit crunch. That was when the shit hit the fan, when Bear Stearns were coming out in 2008 and we had problems. It was about liquidity. It was not about gold. Nobody could care about gold because you cannot pay your debt with gold. You pay it with US dollars. In dot-com recession, we had January to December 2001 also, 0% for gold. Okay, maintained, but nothing big. And especially also because you had a deflationary period there. So you could actually say, well, actually holding cash would have been better. Minus 5% in the early 90s for that recession, in that time frame there. And we saw minus 40 in 1980 to 1982 during that recession. Why is it that everybody says we need to hold gold at the time of a recession? It does not necessarily perform well in a recession time. It actually performs better in good times, if we check. So it's about timing, and it's about macro, and it's about understanding where we are heading. And it's about, when I announce a recession, it's about the type of recession. Because basically, there are two types of recessions that we can imagine. We know the stagflations from the 70s, the oil shock and so on, which is a stagnant economic growth, and then we see inflation starts to run high, and unemployment stays high. And then we know what we have seen for the last many years, what we saw during the financial crisis, what we saw in the dot-com, where we saw falling prices, increased purchasing power, sluggish economic activity. See, the reaction to these two different kinds of crises are different. If you use the tools to stimulate into a deflation, you may get what Bernanke now got a Nobel Prize for, God knows why. But it's basically money printing, so I mean, it was invented so many years ago, but okay, what do I know? But if you do that in a stagflationary period, then you'll just make things much worse. So right now, it's about understanding where we stand at this point here. And now I'm sure many of you are thinking, but Henrik, why recession? Why even talk about that way? We crossed it out. Fed has told us we have a soft landing. So we live in the largest bubble, asset bubble we have ever seen. This is not a meme coin. This is the S&P 500. And if you look at that, that's an exponential curve. It's 16% year-on-year compounded annual growth since 2008. 7.5 times up in 14 years. Show me any period of time where that has happened before. But yet, when I say it's a bubble, then everybody tells me, well, Henrik, why do you say bubble? Well, look at the different metrics we got around it. The PE ratios, comparable to all the great bubbles. We have all the bubbles there, 1929. The market capitalization to GDP was back then, depending on how we do it, 87%. That means all the capitalization, we take all the shares in the US market, we say, what is the value of that? And we then divide it by the GDP. Everything else being equal, we need to have somewhat of a comparison with that. It cannot be that stocks can just expand in size and value compared to the GDP. There must be some kind of connect. Warren Buffett thinks so, at least. I think he's right. Dot-com bubble, 137%. And before the financial crisis, 2007, 107%. 5% it says here. Now, 203%. Okay? So when I'm saying we have a bubble, that's what I'm pointing to. That's one of the things I'm pointing to. And there are many, many other things we can point to. We can point to the crypto market. I don't know how much you follow that, because you're more into the sound money kind of environment, and I like that. But if we look at Dogecoin, or we look at any other meme coins that are coming up these days, I work with guys who are sitting and do that for a daily basis, finding the next thing that's coming, like earning 5-6 times in 3 weeks. Do not tell me that is not a bubble. And the size of that is just getting bigger and bigger. And we are now surpassing almost the all-time highs on the crypto market. We know Bitcoin is around 100,000 because it's probably going to cross 100,000 one of these days here. And I think it will. I think my target is 115 to 123,000. But again, back to, why do people send their money in that direction? Because they expect somebody more stupid than yourself is going to buy your Dogecoin from you. That is why it goes up. So if we have that kind of situation, and we have a super bubble, which I have to say we have, what will then happen? And why should it happen? First of all, we need that pin. We need that pin to come in and disinflate the whole bubble. So it's a balloon, it's blowing up. But we still need the pin. It's not just going to, we can keep it going for some time, but at some point something is going to come and hit it. And that thing is the business cycle. That thing is when things are not well in the economy. So I think, and back to the story also about why I think we actually will have a good time coming down the road, is because of the Fed's reaction. That's why I wrote down on the bottom part here, the response from the Fed will be stagflationary. That's a totally different question. That will come. But until that moment, and that is not here yet, the Fed is so hawkish right now. They're actually helping us now, fueling the car to drive over the cliff into the deflationary abyss at this point. So why do I say that? Everybody knows that the Fed has said that we have a soft landing. So why don't I just obey to that? I like, as I said, like the emperors in the Emperor's New Clothes, to point at it like the little boy and say, okay, here are the coincident economic activity index, the top line. And if we look at that, every time we get a signal where from the momentum analysis of it, it's about the momentum of the economy. The economy is a supertanker. Every time we get that signal there, we have had a recession. No misses. I have a business cycle model that is going back 75 years. Every time it has triggered a recession signal, the recession comes. I did not say in 2022 we're going to see a recession. You can go back on Twitter and look. I was majorly bullish, and I called for 5,700 to 6,000 in Twitter in 2022. I've refined that a bit now. I say 6,300 around that level, so we're getting close. But every time here we have that, and we see we get a recession. This is the whole thing when we talk about now I'll jump down here. When we talk about the soft landing. This up here are the Fed funds. This is the blue line up there, the Fed fund rate. Then we have the 2-year yields, which are the small charts behind that, the bars. Down here we have the unemployment. And here we have what is called yield spread. 10-year minus the 2-year yield. When the 2-year yield rates move above the 10-year, it's the market's way of saying to us, something is wrong. There's bigger uncertainty about the direction of the economy within the next 2 years than there is the next 10 years. Because in the next 10 years, we'll sort things out, but in the next 2 years, things are not going to be good. Look at this. This was a hard landing back here. We had unemployment moving up, and we had a yield inversion. We have here, also here, hard landing, unemployment moving, rounding bottom, yield inversion. Unemployment, yield inversion, hard landing. Even before Corona, we could observe that. So this about you couldn't forecast Corona, you could, but that's for another day. You could do that. Now we have to compare the one thing that everybody's talking about, saying soft landing. And we look at here, Fed was cutting, and unemployment was falling. Not rounding bottom, falling. No yield inversion. Now let's look at what we have today. Unemployment, rounding bottom, yield inversion, the most massive yield inversion we have ever seen, longest ever. So, at least if I'm a good economic detective now, I have to figure out why the butler is the murderer. I could not take this and then say I'm going to have a soft landing, I would argue. Okay, let's look at this again with yield inversions, because then people are saying, yeah, but Henrik, it's just because there's that 10-year minus the 2-year. But actually, if you go across the curve and you say the 1 year, the 2 year, the 5 years, and the 20 years and the 30 years, and we put that up, you'll see every time we have massive yield inversions, it triggers a recession. Something is wrong. The market tells us that. Here, no yield inversion. They moved up, but no inversion. All of the across the curves, across the lines. Here, yield inversion, recession. Yield inversion, recession. Yield inversion, it misses here, but there's a recession, short one there. Here, why would I say soft landing? Okay, let's look at something else then. Let's look at the housing market, because this is about the housing market. Everybody knows the housing market is not, we don't have the bubble we had in 2008. Henrik, come on, it was like 2008, it was a major bubble in the housing market. Everybody knows that, so haven't you studied? Well, what happens in the housing market when yields are moving up is that it becomes harder for us to spend money on housing. This is some of the first thing we cut out, because it's bigger investments and so on. That's the NAHB that kind of tracks that. That is the blue line here. When the blue line, when the party has been going on and yields have been moving up, rates have been going up, you'll see the blue line starts to decline. That is because we start to pull back. At some point, that triggers into the real economy. It takes some time. You can see there's some lag on that before it happens, because it doesn't happen immediately. It's a supertanker. It doesn't turn like that. 18 kilometers. Same here, recession. Now, this was the top. And now we have this, and we see that. I mean, why do we conclude soft landing? That it has not happened yet does not mean that it will not happen at all. We may take a little longer this time for certain reasons, because we had so much stimulus. Everybody had a lot of savings. So now I'm back to this with the water. So obviously we've been able to withhold that spending for a little longer. But still, the NAHB is down here. And we have started to see that unemployment. That's the momentum of this supertanker. It's not about the levels. Then let's look at some other parts of the housing market. Home sales, existing home sales. When that plunges 41% recession, plunges 45% recession, even 20%. Every time we have these big plunges, we see a recession. Now it's down 41% so far. And we conclude, based on this, we will have a soft landing. Well, that's what the emperor does and his tailors, even though we see unemployment starting to move up like what we have seen every other time. What happens is that when the interest rate starts to move up is that the consumer is struggling. So interest payments as a percentage of disposable income starts to move up. When that moves up, then we all have to pay more for our mortgages, for our loans. And that puts a dampener on our consumption. And then eventually we will see that fall into a recession. It doesn't do that immediately. Because first we'll spend our savings. Then we'll cut down on a few things. First luxury goods and travels and so on. But eventually. And this is what the Fed also should be looking into. And now I'm, who am I to tell what the Fed should be doing? But actually, this is the kind of leading indicators we should be looking at. And we should also be looking at things like this. Again, the momentum of it. This is called the Piper-Sandler recession indicator. Every time, going back to the 1950s, we've seen this indicator trigger. We've had a recession. It's a momentum thing. It's not an immediate thing. And I can promise you, and I can see some of you have just as many gray hairs as I have, that some of you may also remember that it took a while. In 2007, actually, there was things actually started to deteriorate in 2006, and we first saw the onset of the recession in 2007, in December. Things take time when this is. So it's a super tanker. So we are starting to see that. And I don't understand why we can conclude based on this, all is fine, it's good. I mean, soft landing, can you see, Henrik? This is the small businesses financial, this is from Game of Trades, always pay tribute to those who make these. So this is the US real prime rate for small businesses, which creates 50% of the US economy, takes up 50% of US economy. Is this a soft landing? This is what they need to pay to invest. It's not. How can I conclude soft landing based on this? Bank credit, year-on-year change in bank credits, all commercial bank. Rounding bottom turns down, recession. Here, recession turning up, down, recession, up, down, and so on. You get the picture. What's happening? Well, because it's expensive to take loans. Why would we take up a loan now? It's so freaking expensive. And maybe the banks are even saying, are you sure you can actually afford that? That's what's happening. And if there's something that the world economy is dependent on, that's credit. So when that rolls over, we are in problem. We have problems. Delinquency rates, credit card delinquency rates. This is the financial recession, into the financial crisis. This means that how many people becoming overdue on their credit cards in the US. Up, down. The consumer is struggling. And I say, when you look at it also from a technical perspective, because that's one of the things I also do, I think we're about to see a very big decline in oil as well. This is more technical, I know that. But we have seen a long time frame here from 23 into 24. It's going sideways, now breaking out of that structure, and also creating something that could create a very big decline in oil. That's just for me. That's more to say that I also do this from other perspectives than just doing this. So I don't think we're going to see just a fantastic time coming ahead of us. I think we're going to see a recession with this. I cannot conclude otherwise. It would be stupid to do the opposite based on this, and I have more if you want to see one day. So I think we have to look into what gold will do in a recessionary period first, and then understand that at some point, of course, the Fed is going to come in and do what they do, thinking we've got another free lunch here, we'll just pour money at it, and then everything will be fine. I think they do something else. And if you look, I think that they're going to do that, but something else will happen. I think they're going to create that bounce, but I think it's going to trigger something which is much worse, which is stagflation. Fortunately, that's good for gold. These are the times we see 18x on gold. But it may not be right now and right here. And if I look at it technically again, gold, new top, and we know it's been front-running everything. A seasoned recession would easily see gold down 30%, 40%. We saw 34% into between March and September 2008 because credit crunch, liquidity. I think gold can easily move down to around 1,600, 1,700. And I think I could also see a case, and actually that would be my base case, around 1,300 to 1,400. in the short time frame. Remember my long term before you carry me out and put me on that fire there. If you look at also the momentum here, you can actually see how they had exactly the same run up to this. Momentum didn't follow. That's the same thing you see now. And I think while we are seeing that gold, it'll be because we get exactly again the same. A credit crunch, Dixie going to move higher, dollar going to crush the world. Once more, that's a deflationary bust. I think we're going to see the dollar moving up to around 121, 22-ish, revisiting the all-time high from 2001. Not in a straight line, actually. I think the top was in today, but let's see. I think the top is in today on the dollar. I think it's going to decline first, but then I think we're going to have a very bad time into 2025. Will not be good for gold, but it will the moment that the Fed comes in to crush the dollar. So it's about timing. And I think also if we look at that was oil saying, I think we have a bigger decline there. I don't want to get too much into that. But the good thing is, as I said, here we had 23 times, 6.5 times, and what else? I think when the Fed steps in here, around that level, wherever it's going to be, let's say 1,300, 1,400, or even 1,700, I think we're going to see something massively after that, because they're going to print like. And that will create a whole new environment for gold. So it's about the timing of this, and again getting in. And then I think there will be fantastic opportunities in the gold sector. That's where I'm also, I'll be one of the biggest investors in terms of what I got, at least in relative terms. I see the gold miners index also dropping to much lower levels. I see what we have seen here so far has only been a bounce in a bigger structure. So I think we're going to see down to around $10 on the on the GDX. Will not be good, of course, but everything is good because then we can invest. And the same here for GDX. We can also say it has, even though gold is at all-time highs, why hasn't it moved? Come on, why hasn't it moved? If gold was a big move higher, why didn't it move? I think it's because we need one more move down in that deflationary bust. And I think we'll end up somewhere down here. But then, amazing opportunities. So, back to my thesis. Major top in indices and crypto, December, January. We are very close to it, I just say. I think there is a chance it could be December, maybe January. Recession sets in Q1 of 25. Deflationary bust, large declines in equity and gold during Q1, Q3. And then we see it towards 75-ish, 1375-ish. Maybe it will be higher, depending on these FIB levels that I work with. We have to see. Fed hesitant during the summer because they will still be scared of their own ghost that they've unleashed with inflation. So they'll be holding back a little more until the moment something big happens, which is what I say. I think there's going to be a financial institution, a country, something that is going to trigger this. And then the Fed will react. Boom, that's the good time. Helicopter money, stimulus, whatever they can, buying up of assets or whatever. Gold reverses and begin upward trajectory. New bull has been born. And stocks bounces as fast as save the economy. Then I think stagflation sets in, longer time frame, now I'm 26. But that will be good for gold. So I think it's about the patience here with gold. And then I think eventually there will be a monetary reset because we need sound money back. And in the midst of sound money is gold.
Thank you, Henrik. I think we got 1 minute for questions. Anybody with a question?
This scenario comes out, why is the central banks then buying hand over fist with gold? They must not be all that stupid to buy at a high price and see it dropping like a stone into 25.
Central bankers are not investors. And they are poor timers and buying gold. We remember what Gordon Brown did. He sold gold at 200. So I don't think we can put say, okay, what the central bankers are going to do. What I'm saying is that they are building up on a more strategic level and saying, we know at some point we have to do a monetary reset. And it will be about, show me yours, I'll show you mine then. And we're talking about gold stacks. That's what it's about.
Yeah, but don't you think a scenario like revaluating the gold to get out of the debt problem is a valid scenario?
Correct. But that's also what I'm saying, 36,000 but it's not now. Because you are not seeing that. I mean, we're right now, right here, next 6 to 9 months, you're not going to see the central bankers doing this. And they will not, with the kind of push and pressure we have on gold prices, if the credit crunch comes and the 122 on the Dixie, the central banks are not going to keep this up. They buy strategically, yes, and that's a good thing. Yep.
No, sorry, guys. We're out of time.
Oh.
I'm sure you're available for questions outside,
Oh, yeah, sure.
outside the room.
Okay.
Thanks so much, Henrik. And reach out to Henrik for any further questions.